I'm going to briefly go over a couple of really nice setups from gold today. It is the 28th of October, a Tuesday. Yeah, there's a couple of really nice shorts, including this short from up here. And also, as well as that, the short from this area. This was a sell the dip short with an entry right there. And you can see that melted lower really nicely. Up here we had a 3 drive above this buy side pull. And so I'm going to give you the narrative and framework around that. Really quick on the high time frame, you can see that we are clearly moving towards these triple daily equal lows. We've got 3 daily lows down here, dropping down towards that. We've failed to climb back into this daily fair value gap up here. So failing to reach this previous day high, consolidating, that's a sign of weakness. So I'm looking for us to take out these lows. We've also recently gone above 4,000, which is right here. We've been hovering above 4,000. We're now collapsing below it, so I'd expect us to go minimum of 50 points below, which brings us to those daily lows. More likely down to 100 points below, and I'd want to see it stay above 780s because we are still bullish high time frame, and the 800s is kind of the maximum I'd want to see it go down to before running high. If it goes down below, let's say 3,780, at that point it is likely a lot more bearish than I expected, but at this point I'm expecting some sort of reversal around this area. In saying that, we are bearish clearly. You can see that we had this failure swing and then this beautiful sell-off, and then we go down to the low time frame on the, bring the 15 up here. You can then see where we're at. That's just a drawing that I've done briefly, but apart from that, you can see that we opened up 1800. Down here, we had initially at 1800, this is what it looks like. The previous day, aggressive sell-off from 9 a.m. We'd pulled back all the way into the close, and then, well, not all the way into close, but then right into the close, we'd begun selling back off, hit all of this internal range. And what it looked like is we had a really obvious low. So a really obvious low of day with a long wick, a high resistance climb back up, and then began selling back off. So we know there's an enormous amount of sell side below this low, and also anyone chasing this short, they're going to trail their stops. So what happens at 1800 is I'm looking at this high. This high was engineered perfectly at 4,000 as well. Traders will see that as a resistance level and be looking to go short based off of that. We also have these smooth highs above. So right at 1800, it climbs, creates a really long wick, closes past the midpoint, indicating bullishness, pulls back to a deep discount, and then has a really nice rip up into this high. Now at this point, we have hit some significant buy side. There is more buy side above here, but this was pretty significant buy side. Anyone from the PM session who was short, that's where their trailed stops were. When we hit that, I then looked at the lower time frames, and I'll show you what that looks like and why I took the short. So here's that sell-off going into the close from 4,000. It's about there. 1800 opens up, consolidates a bunch, pulls back, and then has this nice rally up into the highs. Notice how we're leaving all these smooth lows. We're also disrespecting discount arrays down this area of closing below the midpoint of this wick, breaking intermediate term lows. So showing that it's in a not in a bullish order flow type scenario based on a few of those things. Then once we run into the buy side, we have this pattern. So this is the 3 drive pattern. You can see I usually use the circles to mark them out if I want to annotate them. 1, 2, 3 drives into the high, and then it reverses and gets this nice push low. As soon as I saw this, this reminded me of the exact same thing that happened probably like 3 or 4 weeks ago on gold as well, and there was a short that I also caught. I didn't hold it as long on that time, but this time I recognized the exact same pattern. 3 drives into the high, this entire range from this impulse low up to the high being balanced. So a very balanced range in here. No need for us to come up into the higher portion of this range. So I anticipated that would remain open, this gap up here. No need for our price to reach up into the area. We also have a impulsive leg higher with nowhere for trailed stops, and that is also really key. The only place for trailed stops, if people were to use swing lows, are below this swing low, right there. Make sure that's the right one. And then all the way down at a lot further away from that. So you can imagine there are a lot of traps longs. So what gave me the confidence for the short was the fact that we had hit major buy side, had 3 drives above that level, had a clear balanced range of all this backwards and forwards price action, and a break lower. We had an intermediate term low. We showed no bullish rejection from that low. So what I was anticipating is for us to fail and sell off. So I got short after breaking this low. I got short around that area. And then once it broke below this low again and closed down here, that was actually another entry signal right there. And so I added on this retrace and caught this leg low. So this is the impulse rejection failure entry technique. It's the entry signal is on that candle right there that closes back below this low after retracing above. It's a M1 IRF, impulse rejection failure. And the entry is at the, if we close well past the low like that, the entry is, standard procedure is the midpoint between that closure and the swing low, which would have got us in right there. Sells off really nicely into the range all the way to ERL. Now I did, on one of my accounts, on this retrace, I was holding a runner and I decided to add onto it up here, and as you can see they got blown through. But I'll show the executions for that trade, and then after that we're going to move on to this one, which was actually even cleaner than this, and I actually prefer this one and was quite confident in this trade. As you can see, we're leaving heaps of smooth highs. We barely reached up above any short-term highs here, yet I was still able to take the short and add to it here based on the framework I'll show you next. So we'll start with this one. I'll show the executions. There were a couple of trades in this area. This is the 1800 open. I won't go over those now. But here's the executions. So recognizing that 3 drive pattern into the highs and us breaking lower into this impulse low, because I recognized exactly what it looked like and knew exactly where invalidation would be, I was confident jumping in short there. Adding to the short, this particular add right there was based off of this wick closure closing right back down because it closed back below that low, and so I took a short with a stop loss where it should be based off of that entry. So it didn't invalidate the entire high time frame framework, but just for the low time frame entry, that was where the stop should be. So I let it stop me out there. But then eventually it does sell off and breaks down into a deep discount of this range, taking partials down here because we had filled this imbalance. A lot of the time, if there's an imbalance and then balance price below it, price will drop into that imbalance, balance it, retrace, and then on the second pass through, because this range here is now completely balanced, it has free reign to just run lower in a low resistance fashion. So taking a partial there, anticipating a small retrace, immediately jumped straight back in, probably a bit low, but obviously I regretted taking off so much because I really liked the trade. And then down here, the reason why I took something off right there, I took 50% off of this ad, and the reason why is because this was an hourly candle open. I was feeling a little bit sketched out with the fact that the hourly candle retraced like that and then sold off, and that we were very high resistance down here with my entry right next to it. So I decided, well, I'll just take half off, and then I've basically got hardly any risk on the trade, and I let it run lower down to the lows, holding that one runner, adding up here, which was a little bit impulsive, not gonna lie. And so I gave back a bunch of profits on that ad, getting stopped out at my original stop loss location. There's one more feature of this that I forgot to mention, which was incredibly A+, it is the last second wick. And there is another example of that, I believe. But yeah, last second wick is essentially when a candle of any time frame prints. So let's say there's a candle, it opens, it prints, let's say it's a bullish candle, and then right in the last, let's say 20 to 25% of the candle's time period, it all of a sudden just drops and closes with a very long wick. When it happens, when the wick forms right in the final period of the candle, then a lot of the time that is an actual rejection and price is likely to then reverse. And that's what we see here. If this is not the case, if the wick forms early in the candle and then the candle just consolidates at the low, I see that being more likely to be enticing people to get short, and then it's more likely to run back up the other way. So this entry right here, part one of the confluences for getting short here was the fact that the high here was made at 7:39 p.m. We then begin selling off, still kind of hovering up here. So anyone who wants to get long, at this point, it's still a very bullish candle. When does it start getting bearish? Well, on this candle right here. This is at 7:55 p.m. This is the final 5 minutes of this 1 hour candle. If I show you the 1 hour chart, the final 5 minutes of this 1 hour candle from this open, we traded high, looking very bullish, a bullish pullback, everyone wants to buy, and then it sells off aggressively into the close. That majority of this wick formed in the final portion of that candle, and so I see that as we're trapping people long at the highs and then selling off. And that's resulted in this beautiful push low at 2000. The one thing that's kind of made me a little hesitant on it was the fact that 7:59 p.m. actually rallied just before the 2000 open. And so yes, it was a 1 hour last second wick, but at the same time you could say that this was a low time frame last second wick running back up. But this was actually more so enticing people to get long just before the new hourly candle open and that volume comes into the market. So that actually worked out really nicely. Moving on to the next trade. At this point, what do we have? Well, we've clearly we've taken out this low already, had a really big rejection back up with this wick. So the 2000 opening up, taking out sell side, and then rallying with this nice big rip into buy side. If I got right about the 5 minute chart, I don't need that 1 hour too much, but 5 minute charts, you can see that we had hit this buy side up here, so the previous PM session high, run up into that really nicely, then headed this aggressive pullback. This is what I call the sell the dip, and it's just in opposition to buying the dip. Anyone who is bullish and sees this big run up, they're going to think, cool, the low's in. This is the breakout above 4,000. They're tripping in buy side above these highs, and they are waiting for price to pull back. They're going to buy and then look for a continuation. When I'm bearish and we have a situation like this, and not only that, but we also have no obvious places for trailed stops, then I look for the sell the dip framework, where I'm looking for a low to get engineered, a enticement higher, and then for a break lower. And the logic is that anyone who was looking to buy this pullback and was decided to get long here, they might have bought, put their stop loss at the low, or just not had a stop loss and thought, okay, well, I'll do something like that. And then when price consolidates up here, they might be adding to their position, thinking, cool, I've caught the dip, this is going to be awesome. And then when price aggressively drops lower, all of a sudden, anyone who bought down here, they're trapped underwater. What does price do? Does it run back up to the entry price that they can get out at break even? Nope, it just consolidates and drops lower. A little bit more hope. Anyone who was long and was hoping that this would run up, and it's still long. I think, okay, well, add to my position here, and then it'll come up, my break-even price is here now, so I need even less of a move, and I'm back at break-even, and it just melts lower again. So the narrative for me in trading is incredibly important. All of my best trades and best models ever have been based off of that narrative, or having a strong narrative of who is offside, who is right and who's wrong, and why. There's that famous saying that if you don't know who is the fish, then you are the fish in the market, or something like that. So this situation, you can see 2100 rallies to a premium. Above an hourly open is a premium, below is a discount. So we are above buy side at a premium to the 2100 candle as well, and spending time up there. We then make an obvious low that falls just short of this impulse low. There is sell side below this low, but we failed to take it out, and we run higher. Now in here we also have a bull flag. This stood out to me as well. I would have preferred that we'd run the highs and then sold off, but you can see how in this situation we have a rally and then a consolidation going sideways. Bull flag traders, I'd assume, would see this as a bull flag, which is meant to be a classic bullish retail pattern, and would want to get long. Then when we break lower, you can anticipate that we have traders who are trapped long up at these highs. And this is another model that's a variation of sell the dip that are called leverage shorts. It's where you have a bull flag that fails, and then we attempt to get back up, and then that breaks down. It's not a very clean example of it. I'll draw a little diagram of what I mean. Let's say we have a bull flag, and it fails, breaks down, and then we have a high resistance run back up, and that breaks down aggressively as well. Then you would be able to go short like that and anticipate we should remain heavy, and that would be a bit more of a bull flag looking formation. That's the variation I'm talking about. That's not what this is, but it's similar. But in general, all I want to mention is the fact that we have a large rally that entices longs, a pullback, traders buy the dip. We then have some form of bullish signature, such as a bull flag, and then we break back down to the low. Once we do that, you can anticipate that price will remain heavy, and you can just short with a stop wherever it makes logical sense. That's what this trade was based on. And I'll go over to executions, and here we go. So you can see we have that play out here. You can see that I actually closed my first trade, my initial trade. That was, I just second guessed it. But then the reason I jumped back in is I was watching it, I was thinking this actually does look heavy. Like this is looking really heavy. And if it is heavy, then we should not get back above this point. So I had a really clear way of defining risk. I had at the high end of this long 1 minute wick. We also have a 5 minutes long wick there as well. So 5 minutes long wick and a 1 minute long wick. They are both enticing longs. So that tells me that there are traders who are trapped long up at these highs. So if price returns up here, then the narrative for there being trapped traders is no longer in play. So I knew exactly where my stop should be. We then get this nice drop low, and I will show my executions. So taking a partial here at these lows, at this impulse low. I then added back on once I had trailed my stop down a bit and decided, cool, we shouldn't come back above this high if we are just going to continue dropping. Added into it there. You can see that I did take a small partial off here, very small size, so I took half off or so, and then at that point I was very, very low risk and able to let that run a bit low, and that ended up making back this loss that I had just here basically. So that worked out quite nicely. I've also on my personal accounts made back what I lost yesterday. So yesterday I did have quite a negative trading day, in the sense that I was a bit tilted, but I did actually learn an incredibly valuable lesson from that on profit taking, actually, and profit taking strategies, and determining when to take base hits versus high risk reward profit taking strategies, which I'll make a completely separate video on later. But these are the executions from today, making back what I gave away or donated, the loan I gave the market yesterday. A few more executions. This is right at the 1800 open. I took the similar executions, well, I didn't actually on the other accounts, but this account, looking for us initially, I wanted to be bearish high time frame, but recognized we were likely to take out this high. So when I saw this manipulation closure, a closure below the midpoint of this wick, I figured, okay, well, this is actually telling me it's going to rip. Like right there, I could have got long, but I thought, no, I won't. It runs higher, and then I'm thinking, okay, well, this is a manipulation closure. It could just continue pushing up to this high. Get long, instantly stopped out. Then got back in long, it looks like, with a wider stop. And this is kind of the dodgy part of the execution, is I was buying based off of this signature, but then below it was an area I'd want to buy if this signature failed, which doesn't really make sense, because then what's the point of buying all the way up here if the true invalidation is all the way down here? Surely invalidation for this particular entry is this low, but that doesn't invalidate the framework. So yeah, took 2 attempts on that, had my stops down to the low end of this long wick. That started running up into the highs, closed it out. I did jump in. I put on a position in the other account just here, instantly took it off because I saw that this is actually not looking very bullish. Like this low looked like it was in jeopardy. Set out of it, and then this is where I took the exact same trade. See, on this one, I did not touch it. I didn't try and put that tight stop in. I just put it on the 3 positions, and then I kept my stop above the breakaway gap, so this gap up here, and just let it sit. You can see that I was quite confident in this trade, because this is my personal capital, and typically, from experience, my trading tends to be a bit more profit taking, like a bit faster on my personal account. But you can see I was quite confident in this trade because I didn't touch it at all until I was hitting my first objectives, which were this imbalance being filled, and then adding in back in here, and just like the other accounts, was a little bit 50-50 with the fact there was a new hourly candle opening here, and we had just made this work just ahead of it. But eventually that's played out nicely to my targets. And close this one out here. I was happy with that. And yeah, that was the execution on the personal. So yeah, that will do for that particular trade. Now currently what I'm waiting for is for us to get a closure on the 15-minute chart back below this low. Once we get a closure on the 15-minute back below the low, that is a potential short entry. And I'll show you quickly on the 15 minutes what I was looking at. So this is a framework, a couple of frameworks. The entry is a impulse rejection failure framework where we hit an impulse low, begin to reject it, and then fail to do so, get a closure back below, sells off. Looking for that exact same thing here. Now, what makes this additionally interesting is we have a very similar situation up here where we have a failure swing that takes out internal range high. We then have a retracement before hitting ERL. So the same thing here, failure swing takes out internal range high. We have a retracement, and at the exact same time of day, we have a key signature, which I call the squeeze reversal, or SQRE for short. Squeeze reversal is when a candle of any time frame reverses without taking out the previous candle high. You can see that midnight in this instance sold off immediately and failed to take out the 2300 high, despite the fact that we were literally a few ticks below it. And what does that result in? Well, a really strong push down straight to these lows, and then we get a continuation. The exact same thing played out today already, where we had a 2300 candle right here. Midnight did take that one out, but we had another hourly candle actually no, I didn't. This is the 15-minute chart, sorry. So this is a hourly candle high, 2300. Midnight failed to take that out, made perfect equal highs, but failed to take it out and sold off aggressively. The squeeze reversal, the idea is that it is going to attack the obvious sell side, which in this case is this sell side pull down here, and we've already hit that. So that doesn't mean I can just jump in short, but what I can do is look for a potential continuation. And by doing that, what I want to see is an impulse rejection failure, which will be when we hit a impulse low that should reject price if we're bullish. Like if we're bullish and we hit this low like that, then price should reject straight back up. If we are not bullish, then the opposite will happen, the antithesis. That's my antithesis framework, where we hit the low, begin to reject, and then it fails and closes back below the low. That closure is quite key. And then once it does that, I can look to jump in short. Stop loss can be based off of the low time frame, or on the high time frame, it's just at the failure swing high, and that is expecting that push low. Really powerful entry model, especially if you use it in the right part of the market maker model framework, which if we look at the 1 hour chart, you can see that it isn't particularly clear. Just hide this. It isn't particularly clear where we are within this framework, because we had this sell-off, and then this is a bit of a consolidation, and we've just broken below this consolidation. But within that, we have you can possibly say there's some consolidation in here, and then this being first stage, and then looking for second stage here. But yeah, it's not a particularly clean market maker model framework. Like I can't say for sure that this is first stage and this is second stage, but that is a possibility. Let's say this is a original consolidation. This is the first stage and short-term high to the right, and then second stage down here. Something like that is a possibility. And so if that is the case, and we have then we'd be expecting speed and distance right here. If we get speed and distance, that is where you want to use the impulse rejection failure framework, which is where you have an impulse low, we begin to reject it, close below, and that would be it. So closure back below that impulse low, that becomes the entry with a stop up there, and you'd be expecting a fast move. The key for that entry technique is that you're expecting a fast move, and it's very reasonable for us to get a fast move, especially after having taken out this previous week low, engineering a high at that low, raiding that high, and then selling off with really key liquidity targets. We've recently broken below 4,000, so 4K, and we've been consolidating above that level for like 3 or 4 days or 5 days. Because we've been doing that, we can assume that there's plenty of traders looking to buy support. We've already tripped in those shorts and then run back above, and now we're dropping down a second time, so it's very reasonable to anticipate a relatively fast and abrupt move lower. And if we can get that, then the targets would be 50, which we have not yet hit, so making it quite high probability. And then the 900s all the way down here. So plenty of potential in this short idea. So I'll look to execute that today. And I just remembered one other thing. It looks like we're going to get a new hourly candle open in 5 seconds. But it did not close below that swing low, so I've got another 15 minutes to wait. Hopefully it can run up, break the highs again, and then close below. That'd be ideal. But one of the other things that I wanted to mention, obviously for this short, so the sell the dip short, if I jump back to the 1 minute so we can navigate. For this short right here, we also had a long hourly wick. So that is indicating that traders will see that as a bullish rejection, enticing longs, which fits in with this big rally. And that's exactly what you want to pair with the sell the dip framework. There was one other thing I was just thinking about that I wanted to mention. However, it can't have been too important. Yes, that's right. So if we zoom out, I'll get rid of this 4,000 level, and we draw out a line from the previous weekly low. Where does that line up? This previous week low is exactly where we got those 3 drives into. That's significant because this is a key level of liquidity, old daily highs and lows and old weekly highs and lows. Very key liquidity levels. So when you have setups forming around those levels, that's exactly what you want to see. In this case, we were engineering buy side before rating it, but having those 3 drives into that level was also very strong confidence for this short. That'll do for this video. I rambled on a bit, but yeah, some really beautiful price action, and yeah, see how we go in the London session in about an hour.